Now we're good.
Right. Thanks everyone for coming. We're gonna have food delivered in about 15 minutes, so we'll take a pause to get that. But we're very happy to have Tyler Goodspeed here to talk about skin in the game. Thanks very much.
Oh, there we go. No, it's great to be here. I'm a temporary refugee from the state of California. Everyone seems to be moving this way. I swam against the migratory tide moving the other way. But so I wanted today to talk about a really big issue in U.S. economic history, which is why historically the United States has been so prone to banking crises. And in fact, just since the early 1800s, the United States we've experienced no fewer than 12 major banking crises. During the same period, our neighbor to the north, roughly similar geography, similar economic structure, similar legal tradition, has had none. And so I'm trying to, in this paper, bring a higher degree of resolution to some of the salient features of U.S. banking that may or may not have played a causal role in this anomalous frequency of banking crises in the United States. And in particular, those features include, first of all, the prohibition for most of U.S. history of the ability of banks to branch, not only across state lines, but also within states. A second feature I study is so-called extended liability. So for much of U.S. history, if you were a shareholder in a bank, you would be liable, in the event of institutional insolvency, you would be liable for up to twice, or in some cases, 3 times your subscribed capital. And then a third feature is the provision of some form of liability insurance, either public or mutual, banks insuring each other, and either of all bank liabilities or of banks circulating banknotes only. And I study the antebellum US period because it gives almost a laboratory setting for trying to identify the causal effects of these different regulatory policies, because at that period, basically every state is sort of doing its own thing in the regulatory space, and the highly fragmented nature of US banking at that time allows for some cleaner identification. So banking across state lines was somewhat inhibited by the fact that you didn't have a unified regulatory authority, you didn't have nationwide clearing, you had a lot of discriminatory insolvency laws, so they would, in the event of insolvency, they tended to discriminate against out-of-state creditors in favor of in-state debtors. So for purposes of internal validity, antebellum US banking is a pretty good period to study. For purposes of external validity, for general interest economic journals, let's say it's very high, but all those features that are unique to the antebellum period can, of course, complicate the external validity picture. But the motivation is not just historical. I mean, I think also since 2008, there's been a lot of interest and policy discussion of the effects of implicit guarantees of bank liabilities. For example, Fannie Mae, Freddie Mac. But there are also, we know that explicit guarantees of bank liabilities can also be problematic if that liability insurance is imperfectly or not actuarially priced. And so since 2008, the notion of maybe including equity bail-ins or contingent convertible bonds in lieu of explicit public insurance has gained, no pun intended, but gained some currency. And then finally, there's an outstanding, more contemporary question about whether geographic diversification, for example, following the ending of the prohibition on banks' ability to branch across state lines in the 1980s into the 1990s, whether geographic diversification reduces bank risk-taking, or whether instead banks simply exploit that greater diversification to construct higher risk-return portfolios. Now, the primary limitation on existing studies of ante-bellum U.S. banking is that variation in bank liability regimes and bank liability insurance regimes are likely to correlate with economic fundamentals, attitudes toward bank regulation, which may in turn correlate with differential bank outcomes. So to address this threat to identification, in this study, what I do is I employ a regression discontinuity approach in which I pair contiguously adjacent border counties and then observe differences in whether there are differences in bank failure rates and balance sheet metrics, where if you're a bank on one side of the border covered by this liability regime versus on the other side of the border covered by another liability regime. So I have an unbalanced panel spanning the years 1794 to 1863 and estimate those average differences in failure rates and other balance sheet metrics.
Does it matter that we had, I mean, there were some federal bank charters that happened early in the birth of the country that expired and recaptured? Does that matter? Like Alexander Hamilton's first bank of the United States was used over a 40-year period.
Good question. It doesn't matter given the small number. Like it's basically the national bank with some branches. And then the National Bank Act doesn't come until the tail end of this span. So in terms of how this study relates to some of the existing literature, that regression discontinuity approach is one feature that helps to improve the internal validity, the identification strategy there. Also, I'm able to use with more recently digitized decennial census data, I'm able to control for a richer set of potential covariates than was possible in prior studies. And then also, one thing I do in this study is I look not just at the binary treatment effect of having double liability or not, or having a public liability insurance scheme or not, but also the effects of longer periods of coverage by those different regimes, because I'm interested not just in, as I said, the binary treatment effect, but also on the effects of these different regimes on ex-ante bank behavior and ex-ante risk-taking. So just to give some preview of the results, generally speaking, I find that the longer the period of coverage by double liability, the lower the predicted probability of bank failure. And that's kind of interesting because just the binary treatment effect of double liability doesn't seem to have had much of a differential impact on the probability of bank failure. And that holds in both crisis and non-crisis years. That double liability tends to attenuate the probability of institutional failure. For branching, while a longer period of coverage by branch banking lowers the predicted probability of failure in non-crisis years, it doesn't seem to be associated with a lower predicted probability of failure in crisis years, which goes against some of the existing studies which find that branching was important at limiting risk of failure. And intuitively to me, this makes sense because the whole idea of an aggregate shock is that it is spatially correlated. So that's why I can understand why branching might protect against, idiosyncratic shocks. But if you have a major event like the Panic of 1857 or the Panic of 1837, intuitively, I don't think that's going to branching across within a state is going to provide much protection.
Good question. Can the bank offer loans or accept deposits from the contiguous counties?
No, and actually most bank charters, I mean, it is explicit rules that in order to be a bank of issue, in order to accept deposits, et cetera, issue notes, you have to have a state of New York charter or a state of Ohio charter. Now, you do touch upon an identification risk that there is the possibility of sample contamination. And so I have a strategy for testing for whether there's some contamination, where later on I administer a placebo test, where basically I move the border one level of county inward. So this is a pseudo discontinuity because it's comparing two counties within a state. And if I observe some non-zero coefficients at that pseudo discontinuity, that's potentially problematic because that would suggest that there's something different between those border counties, interstate border counties, and the counties one level to the interior.
Could it also be related to selection in terms of where businesses located themselves, depending on where the kind of banks that they can loans from?
You mean that you might want, if you're engaged in cross-border trade? Yes, but there again, I think we would, if that is the case and it is materially problematic, I think we would expect to observe some non-zero coefficients, estimated coefficients at the pseudo discontinuity threshold. Yeah.
This is just a question on data, maybe for the data. Is this mostly sort of rural counties? I mean, I'm having a hard time thinking of that time period of big cities that would be on a border of the state.
Yeah, so the vast majority are pretty rural. In terms of, in the vector of covariates, I include the best measure of urban density. So if the number of people residing in communities of 2,500 or more, in addition to including a variable for population. But the majority of these are rural counties.
Can I now build up to that? So what fraction of the banking activity is captured by your sample?
So I have in the sample, I have just under 1,000 banks. If I were to calculate what share of all banks, I don't know the denominator off the top of my head, but 1,000 banks out of a few thousand, and 31 covering 31 states, 202 counties, I think 100 something county pairs. But yeah, I can check how many banks total in the country at the time. Yeah. And then generally speaking, I find that that liability insurance regimes elevated the probability of institutional failure in both crisis and non-crisis years. So there are some differences between mutual insurance and public insurance funds, and whether it was insuring all liabilities or circulating banknotes only. Now, another interesting thing is that I find that the longer the period of coverage by double liability, the lower the risk taking is measured by leverage ratios, is measured by reserve ratios, and is measured by methods of financing and the composition of portfolio lending. And this is non-intuitive, and I'll get to the theory a little bit. But it's not intuitive that this would be the case, because on the one hand, yes, double liability means more skin in the game for owner managers, but on the other hand, it means that there's a large implicit off-balance sheet capital buffer, so that could attenuate some of the disciplinary mechanism of preemptive withdrawals, because creditors know, well, they have a bigger capital buffer. The other interesting thing to look at is, because we don't necessarily care about, when we're looking at different liability regimes, we don't necessarily just care about whether it lowers the probability of failure. We also care about how well does it perform during a crisis at preserving the flow of credit intermediation. So I find that by and large, the longer the term of coverage by double liability, the lower the contraction in note issuance and aggregate lending during a major crisis, and the faster the recovery in aggregate lending in the aftermath of the crisis. Whereas the opposite was the case when it came to, and this is contrary to the theoretical prediction, the opposite was the case when it came to the regimes of public and mutual liability insurance. Now, final interesting thing to look at is, all right, so why care about stability just for stability's sake? I mean, it could be that you have some regimes that are associated with greater stability, but also less provision of broad money supply, less investment in industrial development. So I checked for whether there were trade-offs. If some of these regimes were associated with less investment in manufacturing and other measures of development, and I don't see any substantial evidence of a trade-off there. So ordinarily I wouldn't dwell too long on some of the background, but given that not everyone is familiar with antebellum U.S. banking, I figured I would spend some bit of time just going over some of this. So in terms of historical background, the state of New York was the first state to introduce liability insurance, and it was a public liability insurance scheme. So they would assess a fee on your total subscribed capital stock each year, and that was for every bank chartered or rechartered after 1829, and it would insure all bank liabilities. And they had state-appointed commissioners who would examine banks and would have some leeway to impose changes if they found banks to be unsound. Vermont and Michigan followed that model within a few years. Ohio and Iowa instead adopted a mutual insurance scheme where banks chartered or chartered in their bank were mutually insured. And Indiana, but there was a public fund that on top of that could sort of top up in the event of major failures. And then Indiana just had a mutual insurance scheme that levied fees as needed.
Just a clarification, what do you mean by all debts? What's included?
Meaning deposits, notes, other credit that might be provided, but notes and deposits are the biggest.
All liabilities.
So all liabilities.
Okay, so then when you go to just notes, it doesn't include deposits?
Correct.
And how do you widen New York from all debts to notes? What was it?
So, New York's fund was particularly problematic, and it was established, as I said, in 1829. In 1837, you get a major panic. You have the rise. So, I think that there was increasingly a credibility problem, especially when they were only levying a 0.5% annual fee. I mean, is that really enough to insure all bank liabilities? So they move over to just notes. And also there's sort of a political argument that, notes are things that like a lot of small users, everyone's using notes. So you want to be able to protect, small note users, versus people with large deposits. You figure that they might be able to be better informed. It's sort of the same logic for why with FDIC, we insure up to a certain point with the assumption that folks with $1 million in deposits are going to be more aggressively finding out about bank solvency. And then so with the mutual insurance schemes, the supervisors were appointed by the member banks and had a fair amount of latitude to monitor and check unsound banking practices. And just, if folks are interested in the history, there were a couple main factors behind the demise of these schemes. One was the panic of 1837. There was a big contraction in credit, and to help lower barriers to entry to banking, a lot of states started adopting what was called a free banking model, which is basically you want to become a bank, you post $100,000 in state bonds or mortgages, the state comptroller of the currency prints $100,000 in your banknotes, you buy $20,000 in gold and have $80,000 in notes to lend out. That sort of lowered barriers to entry, and so a lot of banks chartered after this movement opted just to become free banks. And then in the 1860s, in an effort to sell federal government bonds, the federal government created the National Bank Act. So, and in order to try and incentivize banks to switch from being a state bank to being a national bank, they started taxing state banknote issuance. So there's just a lot of attrition out of these programs. Then you get an adverse selection that who's left in the programs becomes particularly unsound banks. So that you get sort of a gradual attrition. Now, other states adopted what was viewed as a much cheaper, more efficient means of monitoring bank risk taking, and that was by simply saying, all right, you want to be a bank, you want to be a shareholder in a bank, you have to be doubly liable in the event that your institution fails. So Pennsylvania was the first. Quite a few others followed suit. By the 1860s, double liability was basically the norm. So all national banks had double liability. Most states had double liability. And this was true actually to the 1930s. And then in the 1930s, you have a decline in double liability for a number of reasons. One is that you had a lot of bank failures during the Depression. So you had a lot of personal bankruptcies of people who had very little to do with the day-to-day management of the bank. So that creates sort of a political base for reform. Second, because there were so many failures in the 1930s, there was a view that, well, it presumably wasn't really doing its job at protecting institutions. And then third, with the establishment of the Federal Deposit Insurance Corporation, it becomes very problematic to have both deposit insurance and double liability, because then there is very little disciplinary mechanism whatsoever, because who has an incentive to do sort of preemptive withdrawals? So that was sort of why from the 1930s on, double liability sort of dissipated.
Just a question. So how was that implemented? So did I have to deposit gold for that amount or some other very safe asset somewhere in an escrow? Or I'm just liable and, the bank failed, I also have bankruptcy, so in principle, there's no real liability.
So there's a legal liability that your personal estate is liable for that second half of the double liability. And in the event of the bank failing, everyone pays up their single liability, and then if there's still debts to be made whole, then everyone has to start paying up more. And if you become bankrupt, you become bankrupt. Now, this does create some problem for the fungibility of shares. It's especially a problem when it comes to unlimited liability. So I've done a lot of research on Scotland, where you have unlimited liability, and there, not every share is equal, because a really wealthy shareholder selling his share to a really poor shareholder potentially imposes a negative externality on the other shareholders, because if they have to tap that extended liability and the poor shareholder just goes bankrupt, then everyone else has to pay more. So that's why you have in co-partnery agreements, they would often have a lot of rules pertaining to share disposals, that the other partners wanted to make sure that who's buying this share is not going to impose negative externalities on the rest of them.
So I'm just trying to understand, so do we know how many, the average kind of, how many of these shareholders there are? And also, are they local, or is it people from out of the
local, big heterogeneity. We're probably talking in the tens, few dozen. But you actually touched upon a very good point, which I'll get to in a bit, which is the efficacy of extended liability may have an important interaction effect with things like branching. Because if all your shareholders are just, in the same local market, it might not do much good to have extended liability, because if there's an adverse shock in that locality, they're all they're all wiped out. Yeah.
My question is similar. I'm curious, what was the recovery rate of the second level of liability, the empirical level? I mean, this would sound great, yeah, all this liability, but then it happens, and then you get it back, and there's some living mechanism whereby, okay, maybe it's effective, maybe it's not effective.
Yeah, so off the top of my head, I can't remember average recovery rates for single liability versus double liability, but Macy and Miller in 1992 did look at precisely this, and they found that recovery rates were substantially higher under double liability than under single liability. As I mentioned, I've studied the Scottish free banking period, and it's very interesting there because the one financial crisis over 130 years of Scottish banking history during this free banking period, and in that one financial crisis, of the 16 banks failed. Of the banks that failed, only one had more than 6 partners. And of the banks that failed and imposed losses on creditors, all 3 had fewer than 6 partners. So there does, there does seem to be, to that interaction effect point. I think the interaction of extended liability with the ability to geographically diversify is an important one. And then finally, branching in terms of history. As I said, this was one of the most enduring coalitions in U.S. political history. The prohibition on the ability of banks to branch not only across state lines, but even within states. A lot of rural banks wanted it because, at least during good times, it gave them some monopoly power. A lot of urban banks kind of liked it because it meant that they could be the urban correspondent bank to dozens or hundreds of rural banks. And farmers wanted it because it was a way to credibly bind the lender to the state of the local economy. So this was an incredibly enduring political coalition. How am I doing on time? Okay. Now it's as I said up front, it's important to remember during this whole period, U.S. banking was very fragmented. I mean, so you didn't have nationwide clearing, you didn't have a harmonized regulatory system. There were explicit charter rules against banking across state lines, and there were discriminatory insolvency laws. So this helps with the cleanliness of the identification strategy, but it does raise some issues potentially with external validity.
What was the reason for intervention? What was the rationale?
The rationale given, rather than just protecting rents, I don't know, to be honest. But yeah, I think it would. But in fact, it was, as I said, in the interest of most of the constellation. Yeah. Well, also, I mean, so the main argument would have been, as it is or it has been in more recent decades, that look, if you allow branching, then you're going to get a few big players, and they're not going to want to branch in this rural county because it just won't be sufficiently profitable for them to do it. So you're not going to get sufficient credit in some parts of the economy. Is the argument that has been put forward in more recent decades. So there's a big literature on both the theory and the empirics of this stuff. I can start I don't want to spend too much time because most of these people already have tenure. But the main theoretical, but I should note up front that in theory, all of these liability regimes are ambiguously signed in terms of their effect on stability. So the argument for deposit insurance, theoretical case goes like this. Banks invest in relatively less liquid, relatively longer term assets, the value of which is opaque, and they finance that investment by issuing relatively more liquid, relatively shorter term liabilities that are redeemable on a first come, first served basis. That means that in the event you put those things together, it means that in the event of an adverse shock that people can know has occurred, but they don't, and they know that it has impaired some tranche of bank assets, but they don't necessarily know the incidence across banks. Therefore, in order not to be last in line in a first come, first served system of redemption, there's an incentive to run the bank.
I think it's even worse, we don't actually need a shock. It's
Just the belief, yes. And these fears can become self-fulfilling because an institution facing reserve drains might need to preemptively call in loans, curtail lending. They might need to liquidate some assets at fire sale prices, and then you can really start to have a cascade of credit disintermediation. And so deposit insurance or liability insurance is supposed to mitigate the incentive for such runs, but can be ambiguously effective at doing so because, oh, is lunch arriving?
Yes.
Okay. Yeah, we can, yeah, should we pause for food?
Sure.
Sounds good. I might grab some water myself.
Yeah, right.
Where do you get to?
Two, yeah, okay.
I wrote it down on my account.
That's the theoretical case for liability insurance, but the extant literature, empirical literature on bank liability insurance has highlighted that, of course, it also has the potential to introduce potential moral hazard if that liability insurance is imperfectly or unfairly actuarially priced. Because with privatized gains, socialized losses, banks are encouraged to substitute debt for equity and to maintain lending portfolios with higher risk return profiles. And the disciplinary effect of preemptive withdrawals from problematic or high risk banks is throttled a bit. And sure enough, a lot of the studies, particularly by Charlie Calamiris, have found that the public experiments in liability insurance were pretty substantial failures, although Charlie and others do find that the mutual insurance schemes did a very good job at limiting the risk of financial institutional failure. I actually find that the mutual insurance schemes weren't very effective either, and that the evident effectiveness of them was driven almost entirely by the fact that the one state the states that had mutual insurance also had double liability and branching, and so it was double liability and branching that were driving that superior performance.
Who was the mutual and the mutual insurance?
That was Indiana.
Pardon?
That was Indiana, was the mutual insurance state.
No, I'm sorry. Who was sharing the risk in the mutual?
Oh, right. So all banks, all state chartered banks. So if you were a bank chartered in the state of Indiana, you had to be a member of the mutual insurance scheme.
And so you insured the bank down the street.
Correct, and he insured you. There's also big literature on double liability, and here again, or here the evidence is pretty mixed. If we think back to efficient contract design 101, efficient contract design will tell us that liability should be allocated to the contract party that is least risk averse, and to the contract party who has the lowest cost of acquiring information. So when we think about banking and the structure of banking, what banks do, assuming the standard contractual structure of banking, issuing short-term liquid liabilities to fund longer-term opaque, less liquid assets, we would kind of expect this contractual model to point to allocating greater share of liability to owner managers rather than to lesser informed depositors. Moreover, if depositors and other creditors are at an informational disadvantage relative to shareholders and owner managers, then limited liability might incentivize owner managers to pursue higher risk return strategies. So I guess we don't have to get too much into option theory, but basically the way it works with contingent liability is it's equivalent to being long a call option with an exercise price equal to the face value of your deposits minus your maximum liability assessment, and short a bond with a face value equal to the maximum liability assessment. So you get this convex payoff function. So the payoff of for shareholders is a linear function of the asset value when asset values are in excess of debt. But if the debt value is greater than the asset value, then that call option becomes worthless, and the limited liability will become effective, and the payoff for shareholders is zero unless you have double liability or triple liability or unlimited liability. So banks operating under limited liability can increase their equity value, their return on equity, by exploring the tails of the distribution of asset returns. But and this is why it's ambiguously signed. On the other hand, as I said earlier, you have that implicit off-balance sheet capital buffer that creditors know about. So it's also conceivable, especially I guess in a Modigliani-Miller world, that off-balance sheet capital buffer might disincentivize preemptive withdrawals, and you might even see measured leverage go up because of that off-balance sheet buffer. So this is why it ultimately becomes an empirical question as to how these two things weigh against each other. And the empirical evidence, as it turns out, is mixed. I hope this paper helps settle it. But some folks have found that leverage ratios were lower in states with double liability. Others find that leverage ratios were higher, measured bring a greater degree of or a better identification strategy to bear on the question. Okay, so as I said, have almost 1,000 banks in the sample, located in just over 200 counties, 31 states, 157 contiguous border pairs, spanning 65 years. I get the bank data, balance sheet data from the work of Warren Weber, and he not only has a start date and an end date for each bank, but then whether they failed or were still in existence. And those are at the location, so I mapped them to counties using the ANSI codes, and then also for county level covariates, use the decennial census data for things like population, the percentage of the population living in municipalities with more than 2,500 inhabitants, agricultural and manufacturing output by value, and also binary indicator variables for whether in that decennial census year the county had a navigable waterway or a railroad. And I basically, for years 0 through 4 in a decade, I assigned the preceding decennial census values for years 5 through 9 in a decade. I assigned the succeeding decennial census values. Also, you can interpolate. It doesn't make much of a difference. Yeah.
So suppose you're looking at a particular county here in the border, and I know that on one side of the border, I'll have to put my capital or double liability, and then the other one I don't. That would, I think, imply that first of all, the selection of where I go into, but also there should have been an indication for profitability on both sides of the border, right? Because if on one side I have to risk my capital, double the amount of capital in this case, but then the other one I don't, there should be implications for competition and profits and things like that. I don't know how to control for that.
Right. I mean, there's a differential expected return on equity, but there's also a differential expected return on debt. Because if on one side, I have single liability, then yeah, if I'm investing equity, I don't need as much of a return. But if I'm investing debt, if I'm a creditor, then I'm probably going to want a higher return. Similarly, with public deposit insurance, on one side of the border, they're going to be differential returns for both debt and equity, and how those. Those might cancel each other out.
No, but the concern is like there's a higher sort of enterprise value. This is by double liability, I'll be less likely to, go under.
Yeah,
I'm more inclined to save the bank, or maybe partly by taking actions to change the distribution of outcomes, but also conditional on facing a bad outcome. The enterprise value could be higher, and therefore.
Yeah, no, I think that's a really interesting question. And again, the falsification exercise, SIBO test, should tell us whether something is going on right at the border or not. And then secondly, I look in a later section when I'm looking at whether there were differences in sort of broad credit provision, the number of banks. It actually turns out that with double liability, you get more banks and greater dispersion. So, like if you have I have a Herfindahl index of sort of bank concentration, and it turns out that with double liability, not only do you get more banks, but you get actually more bigger banks and more smaller banks. And I think the logic there, and this is something again that I saw a lot of in Scotland, is that extended liability can often facilitate new entry, precisely because you say, look, we shareholders stand behind this institution for up to twice our subscribed capital. In the Scottish case, it was unlimited, and what you would see there was a new bank would get started, and they would take out public advertisements listing. I can't believe I just said advertisements. You can tell where I did the research. They would take out public advertisements, print public broadsheets listing the shareholders and noting upfront in bold, these people stand behind this institution to the full extent of their personal wealth. So I think that's why, yes, I can see on the one hand it's more difficult. You got to have more capital at the ready, but on the other hand, it can also facilitate greater ease of entry, because it allows you, if you're issuing notes, it allows you to sort of have that lift off, because people know, okay, these 24 people stand behind this institution for up to twice their subscribed capital. Okay, so the empirical approach is based on estimating average differences in failure rates and balance sheet metrics for banks in counties covered by liability insurance, or double liability or branch banking, for an additional year, or covered by these regimes, or covered for an additional year by these regimes, versus failure rates and balance sheet metrics for banks in contiguously adjacent border counties not so covered. So I define bank failure F for bank I in county C in state S along border segment B at time T as a binary variable, assuming a value of 1 if bank I failed and T was its final observation, at 0 otherwise. And then Y is just the outcome variable of interest for bank I in county C, state S, etc. So these are things like leverage ratios, the share in the portfolio of real estate lending, the share on the liability side of notes versus deposits, that sort of thing. And then chi is just a vector of available county level covariates. Lambda are county fixed effects, and then I have county pair by year time fixed effects. Now, as an alternative specification, so first I just estimate this as these are all binary variables. As an alternative, are all continuous variables. Then as an alternative specification, I estimate them as binary variables, and then we can see by comparing those coefficients what matters more. Is it just having these regimes in place, or is it more important that the regimes are in place for a longer period of time? Now, I should say up front that I think this is a misspecification for 2 main reasons. One is those interaction effects that I previously mentioned between branching and double liability, and also between potentially double liability and public liability insurance. I think this is also a misspecification because when I define these as continuous variables, there's an implicit assumption I'm making, which is that expectations are adaptive. Because otherwise, we would expect you get a regime change, and immediately, your capital structure and your portfolio adjusts. Now, for me, in my mind, the way I'm thinking about this is like with branching, it makes a lot of sense to assume adaptive expectations because you got to research the market, you got to develop new clients, attract a depositor base, and even with double liability, you inherit a portfolio and a capital structure that were constructed under one regime, and it might take some time to adjust to the new regime. But in any event, one thing I'm working on now is to incorporate some time polynomials in here, because presumably these are not linear relationships between the continuous variables and the outcomes. Now, in addition to evaluating whether banks and counties covered by liability insurance, double liability, or branch banking for a longer period of time experience systematically different balance sheet changes and failure probabilities, I also look at whether they experience systematically different balance sheet changes during and in the immediate aftermath of a major crisis, namely the Panic of 1857. So here I estimate average differences in balance sheet changes at the policy discontinuity thresholds in 1857 and 1858 relative to their 1856 averages. And this is so that we can see, all right, so even if liability insurance was associated with higher victim probabilities, is it at least doing a good job at attenuating reserve outflows or facilitating recovery and credit intermediation in the event of an adverse shock? And then here at the county level, so this time here I'm estimating at the county level, but still at time unit T, because there are multiple time observations in the course of a year. Here I'm estimating average differences in credit and note circulation per capita, the number of banks, and also bank concentration, to start to see if there was some trade-offs between stability on the one hand and broad credit provision on the other. And then finally here, this is again estimated at the county level, subscript N, because it's now at the decennial census year. So here I'm just estimating I'm estimating average county level differences in manufacturing and agricultural output, capital invested in manufacturing, and infrastructural development. So whether there was a railroad or navigable waterway. I'm sorry?
Are they changing over time?
They are.
Oh, they are.
Yeah. Because, I'm sorry?
You're gonna do a different diff.
I am going to do a different diff. I haven't done a different diff. So this is just, as I said, the continuous variables and the binary variables. But yeah, that is on the to-do list as a canonical diff and diff. But yeah, you actually have a considerable amount of development because these are the decennial census years, 1820, 30, 40, 50, 60. So there is a lot of canal and railroad development going on during this period. So the identifying assumption throughout all these specifications is that assignment to treatment by public liability insurance, mutual liability insurance, double liability, or branch banking within each contiguously adjacent county pair is uncorrelated with differences in outcome residuals in either county. Now, the primary threat to identification is, of course, that while county assignment to these different regimes is potentially correlated with unobservable variables that are in turn correlated with differential bank outcomes. So I addressed this in 4 ways. One is the regression discontinuity. So presumably border counties share pretty similar economic fundamentals, social and cultural attitudes toward banking, so that the sharpness of those discontinuities should help attenuate this threat. Second, I directly control for potential covariates that we can directly observe and measure. So those are the things I mentioned before: population density, urban population, manufacturing and agricultural output by value, et cetera. So these may have varied systematically across the discontinuity thresholds and correlated with differential bank outcomes. So we throw them into CHI. And then third, county fixed effects to control for differences that may have varied across counties but constant across time. And then the pair by year fixed effects for year specific shocks that may have varied over time but were constant across border segments. And to the extent that state banking laws and fragmentation inhibited cross-border banking, contamination should be limited. But as I said earlier, as a placebo test, I moved the border one level inward and test whether we observe differences, systematic differences at that pseudo discontinuity threshold, with the identifying assumption there that assignment to interstate border adjacency or non-adjacency within each intrastate county border or county pair is going to be uncorrelated with differences in outcome residuals in either county. If I do see some non-zero estimated coefficients on those pseudo discontinuities, on those gammas, then that's a worrying sign.
Is that line part of the law? The one interior, like finding the pair? I'm trying to visualize. State lines seem pretty crisp, like the interior line, like the surveyor's going away. That makes sense.
And I would say that you can just very easily. Okay, is it a border? Are you an interstate border county? Do you border? Which intrastate counties do you border? And then you can just construct the sample that way.
If we border 3 other counties and we do all 3.
Yes. Now yes. So since I'm interested in average differences at each contiguous county border, I consider all contiguous county pairs, meaning an individual bank will have M replicates if it is located in a county belonging to M distinct cross-state county pairs. Now this is an issue because it does introduce some mechanical correlation. So, and also there's positive serial correlation within bank balance sheets over time. So that's why robust standard errors, clustered for that, because of that mechanical correlation issue, I cluster at the bank, state, and border segment levels. Now that's also an issue because I only have 31 clusters in the state. So the standard errors might be problematic. So I contemplated a wild cluster bootstrap that kind of struck me as a bit scary and Bayesian. So I did the McCaffrey and Bell bias reduced linearization, sort of inflate the residuals to adjust
Do you
them.
have enough observations to pool the banks in the state border or the set of adjacent county borders?
I have enough, yes. So because there are 1,000 banks, there are almost 35,000 observations, and 157 county pairs. So yeah, I'm confident in. How are we doing on time? So now we get into the results. So these are the this is estimating the first specification with the relevant policy variables specified continuously. So what this is saying is that banks in counties with an additional year of coverage by double liability had a 0.1 percentage point lower predicted probability of failure than banks in counties without, in contiguously adjacent border counties without. And what's interesting about, so double liability, we have a lower predicted probability during the whole sample, during just normal years, and also during the crisis of 1857. I can't reject the null for 1837.
And what's that conditional?
I don't remember the unconditional failure probability. I might. No, I don't have that here. If I recall, it's pretty high, like 10, 15, like 16%. You have a look.
16.1.
So this would be like going from 16 to 16.1. But this is continuously. So this is an additional year is associated. So if you have 10 years, yeah. So if this is indeed linear, then 10 years of additional coverage by double liability, you're 17%. But even more when you're looking at a crisis year. Branch banking, as I noted, was associated with lower predicted probability of insult failure, but that is entirely driven by non-crisis years. And then it's kind of a mixed bag with the different liability insurance schemes, but generally speaking, the liability insurance schemes were associated with higher predicted probabilities of failure the longer they were in place. And that was true very variably in both crisis and non-crisis years. Now these are the predicted probabilities of failure using just specifying these variables as binary variables. And here we don't see many statistically significant results. So this is in contrast to a lot of the extant literature, which does find a lot of statistically significant results for the binary treatment effect. So I think this is where the enhanced identification strategy helps shed some more light on whether this is just a case of a binary treatment, you have it or you don't, versus the effect of a longer period of coverage.
So this is you have it or not the year in that year.
In that year. Yes. Actually, not even at that time period, at that time observation, because there are multiple observations within a year. So you have it or you don't at that point in time.
But these policies don't change very frequently.
I mean, you have 31 states that are introducing or not introducing the policies at various times. Some states, like I think it was Pennsylvania, implemented double liability, revoked it, then went back on. But yeah, I would say relatively.
Are you, maybe I missed it, sorry, are you using some kind of a staggered introduction to help you further?
Not in these specifications, but that is where the diff and diff is going to come in future iterations of this.
So wouldn't the binary be just the average of the continuous measure? So I'm trying to figure out why there is often so different between the binary and the continuous measure.
I mean, there's going to be asymmetry in periods of coverage. So, if during the sample, 2/3 of the time you don't have a particular regime, and then 1/3 of the time you do, then I think that is gonna, for that reason, the binary is not going to just be the average, the simple average of the continuous. So here I'm looking at whether there are systematic differences in various balance sheet metrics on the asset side. Again, and this is where they're defined continuously. So here, what this is saying, for example, is that the ratio of total liabilities of deposits. So here the ratio of real estate lending to total assets was 0.1 percentage point lower for banks in counties covered for an additional year by branch banking, relative to banks in contiguously adjacent counties not so covered. In terms of, without getting too specific about the magnitudes, I mean, basically what we can take away from this is that double liability was associated with lower measured leverage ratios, which would suggest that the effect of owners having more skin in the game outweighed the effect of the bigger implicit off-balance sheet buffer. We also see that whereas banks and counties covered by liability insurance schemes were more exposed to real estate and more exposed to interstate lending, banks in double liability counties were ever so slightly, I mean, again, this is these are continuously defined, so the magnitudes are pretty small, but we're slightly less exposed to real estate lending. Yeah.
So what's the implication of the proportion on mutual loans and the leverage ratio? What do you think is driving that?
I don't know.
I mean,
to be honest,
is it like failure of market discipline that's allowing them to take on more leverage, or is it the fact that creditors are feeling more comfortable and they're allowing them to take on more leverage? Can you differentiate between those two?
I haven't yet. It's driven by one state. And so, to be honest, that's something, because there are a number of areas where the mutual notes variable has some kind of wacky, large magnitude estimated coefficients. So that is something that I'm still trying to figure out what's going on with some of the mutual notes ones. I don't have an answer because it's just so much bigger in magnitude than all the others.
Yeah, is that 40% more leverage?
Yes. So I mean, it's not; those aren't percents. It's leverage. So it's a ratio. So it's not unit. But it's an additional year of coverage by mutual insurance and notes is associated with a 0.43 point higher leverage ratio.
So it seems that previously in internet banking, internet banking are risky, and so they do more if they have
Historically, at least, real estate lending is can be more risky. I mean, it's all because there again, it's that you have a longer term, less liquid asset. So if you have an adverse shock or a crop failure or whatever, I mean, that's potentially problematic for the portfolio, and it can generate the sort of run dynamics, because people know that the financial sector is exposed. So that can tend to be, well, real estate over the long run is actually pretty safe, but the tail risk can be substantial.
But then the branch coefficient is negative. So I was expecting the branch to be public coefficient.
Well, except that, remember, one of the reasons for unit banking, so the prohibition of branch banking, was to bind the lender to the state of the local economy. So it was in part to try to push more lending into the local real estate market. So I think the fact that when you can branch, you get a little bit less exposure to real estate lending as a percentage of assets, could be indicative of, when they were allowed to branch, they weren't quite as bound to that local real estate market.
What's the average leverage ratio?
I don't know. Below 10, but I can't remember. Yeah, I want to say it's like 5 or 6.
So, just trying to understand the magnitude. So if you can go back to the previous one, so if you have double liability, you would go from what to what, more or less? Approximately, I'm just trying to understand.
If you've had 10 years of double liability, then your leverage ratio would be higher by 0.36 units. Sorry, lower by 0.36 units.
Okay. So instead of 6, it would be 5 point something.
This is looking at the liability side of the balance sheet. So here we see, so for banks in counties covered for a longer period of time by double liability, we see a little bit less reliance on deposits, a little bit more reliance on notes, similarly for branch banking. I think it's important to remember that in the context of early 19th century US, deposits are the innovation. So note issuance has been around for a while. Deposits is the new financial innovation. And the thing about notes is that it's a lot more there's a lot more visibility about who's over issuing. You see these things circulating. The problematic banks, the higher risk banks start getting notes coming back on them for redemption. Whereas deposits, I think, introduce a little bit more opacity on the liability side in terms of who's sort of over issuing. And so I think that's why the notes were a little bit of a safer funding mechanism. And you get that regular discipline of those notes coming back to you for redemption. Whereas we see variably with the different, depending on the liability insurance scheme, but we do see a little bit more reliance on deposits, a little bit more reliance on interbank lending, interbank borrowing, and some lower cash reserves. So basically, holding it in the till for redemption. Now, I don't know, with the branch banking, it seems to be more cash reserves. I don't know to what extent we can take that at face value, because there might have been some anticipation of when the bank examiner was coming around to do an inspection, and so if you have branches, maybe you can preemptively shift cash. So I wouldn't put too much stock in that. Now this I find really interesting, because this so these are the post 1857 balance sheet changes, average balance sheet changes, and what we see is that by and large, in the aftermath of a major adverse shock with the panic of 1857, we actually see a relative increase in note circulation, deposits, loans, and interbank lending. So faster recovery, basically, in credit provision for banks in counties covered for a longer period of time by double liability. Whereas we don't see much of an effect of branch banking, which as I noted before, is kind of in contrast to what previous studies have found, where we found that the branching was effective at mitigating disruption during some of these adverse panics. But as I said, to me, the intuition is that when you have a major aggregate shock that's spatially correlated, we wouldn't necessarily expect branch banking alone to be able to resolve that. And then the liability regimes and insurance regimes don't seem to have done a particularly effective job at attenuating credit disintermediation during and immediately after the panic.
I'm sorry, how do you explain double liability coefficient? I was expecting the opposite. During after a shock, all these people, all these wealthy investors lost their money because they bought liability, so they're not actually working capital there.
Well, except, the way it would usually, there was less of an incentive to run on the bank in the event of a shock like this, because you knew that even though there was some tranche of the bank's assets had been impaired, there was an additional capital buffer. So again, going back to the Scottish case, this is something that I observed a lot, is that in the event of a crisis, they would go all out, publishing, who the names of the shareholders, their assets.
No, I can see data. I can see how it can be nice data in terms of issuing loans after the crisis and capital becomes expecting wealthy shareholders to allow.
Well, except that for an individual bank, but in the aggregate, if the banking sector in the aggregate in the state has been less impacted by the panic, in part because they were more disciplined before the ex ante, they were less risky, in part because there was less of a fear to run. You put those two things together, and in the aggregate, at least, you're going to have a faster recovery in credit provision. Because first of all, you weren't as risky beforehand, and secondly, there wasn't as much of a need to run.
Again, to understand what we're doing in the condition, so this is how much you change things conditional on having survived the crisis. After the crisis, just we're trying to remember the specification.
Yes, so this is your average change in note circulation deposits relative in 1857-58 relative to your average 1856 levels by bank.
So this is during the crisis? Sorry, I don't know the date. So this is during the crisis, not post-crisis.
This is during and immediately after. So, or sort of, because it's 1857 bleeds into 1858. So this is 1857, 1858.
Okay. So you could read the double as saying it's decreasing overall because this is a crisis, that you're decreasing that.
Yeah.
It's not inconsistent with the idea that maybe these guys are capitally constrained. They're not growing, it's that they're shrinking less than peers.
Correct. This is relative. Right. Yeah. That very important point. Yeah. So this is relative to banks in contiguously adjacent border counties without. Now here I'm looking at whether there are systematic differences in provision of credit, the number of banks, bank concentration. So one of the interesting things is we found, I find that branching and double liability were generally associated with lower predicted probabilities of institutional failure. That doesn't seem to have come at the cost of less total capital credit per capita, less note circulation per capita. With branching, we do seem to have fewer banks and more concentration in the banking sector, whether you're looking at all assets or just note circulation. And that's part of the reason why a lot of people were fearful of a lot of rural banks were fearful of branch banking, is because you do get fewer banks, bigger banks. With double liability, as I noted earlier, we actually see more banks, but also more concentration, which would suggest that there's just a greater dispersion in bank size. And then when it comes to the liability insurance schemes, ironically, they actually seem to be associated with less credit provision per capita, fewer banks, and not too much of a difference in terms of concentration. And then finally, this is where I look at whether there are systematic differences in basically different measures of development. And by and large, the answer is no. There's some funny things going on maybe with some of the mutual insurance schemes, a little bit more invested in manufacturing, the manufacturing output at the expense of farming. But again, that mutual notes one is it's driven by one state, and so I'm still trying to figure out what's going on with a lot of those estimates. But other than that, I mean, again, there doesn't seem to have been a big trade-off between stability on the one hand and broad provision of credit and industrial development on the other. So this is where I move that border one level in. So if a lot of these have been shown up as, you know, significant estimated coefficients, that would be pretty worrying. But these do tend to be pretty small and by and large not statistically significant, which offers some reassurance that interstate border discontinuity is pretty sharp. Which, you know, you speak to old school economic historians, and they will say, well, yes, I mean, because mobility was also just a lot lower there then. I mean, you look at a lot of these border samples, a lot of these border counties, and it's just, you know, it's not as easy to just move capital and people across borders to engage in interstate border banking, especially when you have the legal prohibitions against it and the limited capital mobility because of, as I noted, some of those institutional features, including discriminatory insolvency laws. So in terms of broader conclusions, I mean, as I said, longer periods of branching tended to lower the predicted probability of failure in non-crisis years, but not so much in crisis years. Whereas and longer periods of coverage by double liability were associated with lower risk taking on both the asset and liability sides of the balance sheet, and with lower predicted probabilities of institutional bankruptcy. And whereas the mutual and public liability insurance schemes tended to be associated with higher predicted probabilities of institutional failure and also greater risk taking, again, on both the asset and liability sides of the balance sheet. But there don't seem to have been systematic differences in money supply, broad credit availability, or industrial development. And I'll pause there. Hopefully we'll have some time for questions. And I think I have the more fun talk later this afternoon. Thank you.
So when you do the continuous thing, you're basically sort of forward-looking sometimes. Or it's sort of accumulated up to that time.